Hey everyone. As has been the case for the majority of the year so far, there are a lot of short-term disruptions. There's the government shutdown and the ensuing limitations on data availability. There's the renewed friction in trade negotiations with China. And of course, the question of whether we face tariff-driven inflation risks. But as we enter the fourth quarter, the economic forecasts for 2026 are starting to get dialed in, and I want to focus on what I'm seeing there. First, there's the question of recession risk, and although the labor market looks weak, the GDP forecasts remain relatively positive. The blue chip consensus forecast places GDP growth at 2.5% for the third quarter this year, stepping down to 1% in the fourth quarter, then scaling back up again in 2026 to a forecast 1.8% growth for the year. In general, according to the 44 economists who participated in the blue chip survey, the risk of an impending recession remains relatively low, at least based on their quarterly GDP forecasts. Very few of the economists are predicting any quarters of negative economic growth at this point. In terms of inflation, the consensus CPI forecast is landing around 3% over the next couple of quarters and through 2026. And roughly 2/3 of the economists believe that the tariff impact on inflation will basically be a one-time lift, then inflation will flatten out. So while the risk of stagflation is still out there, the majority of the economists in the survey aren't predicting extended inflation risk or elevated recession risk, which suggests the economy could generate slow but steady gains through the coming year. In addition, their forecast for the 10-year Treasury remains low in the 4.1% range all the way through the end of next year. Their Treasury forecasts are amazingly flat. Now, we have to remember that these forecasts by leading economists are taken at a single point in time. In this case, the survey was taken in early October. Maybe their forecasts are flat because right now it's hard to predict the future, so their default is to leave things flat. That said, I think these forecasts are pretty optimistic in general, and if they pan out, they would be positive for commercial real estate. They lead to moderate but durable space demand that would slowly build occupancy levels and rent growth. Now, although the Blue Chip survey doesn't forecast job creation, it does predict the unemployment rate, and their unemployment forecast remains stable in the mid 4% range through the end of next year. In addition, many of the Blue Chip economists have reduced their break-even job creation level from 75,000 jobs to 64,000 jobs per month. That reduction in the break-even level reflects the likely fall-off of international immigration to the United States. Fewer people moving to the US means that it takes fewer jobs to keep unemployment flat. So if the unemployment rate treads water through next year, only about 750,000 jobs would need to be created in 2026. Taking all of this together, the consensus blue chip economists are basically forecasting slow economic growth and modest job creation with inflation that's higher than the Fed likes, but isn't surging. And as a result, interest rates are predicted to remain relatively low, near 4%, but not really going much below where they are today. So, if this steady-as-she-goes economic outlook holds true, first of all, it would be a welcome reprieve from the volatility we've had so far this year. But secondly, it would support steady demand for all types of commercial real estate. Now, I'm not going to refute the forecasts of 44 of the leading economists in the country, but I do think we still face some substantive headwinds that could unravel many of these predictions. In general, investors should carefully monitor what happens with tariffs in the coming months, especially as we spin up for the holiday season. And I'm still concerned about the slowing pace of job creation. If hiring is actually downshifting into job losses, as we've seen in the recent ADP reports, that could be cause for concern. In addition, I think we need to keep our eye on inflation. I don't think we're out of the woods yet. The September inflation report, which, though delayed, will be released on Friday, October 24th, despite the government shutdown, could shed some light on whether inflation is going to be a problem. So, while the blue chip economists are reiterating the durability of the US economy, which is totally valid, I still think there are a lot of variables in play, which is why investors always need to keep their eyes on the horizon.